I think it's a challenging environment for equities, and part of the reason why bond yields are where they are is because markets are pricing in growth concerns, which are obviously bad for equities. But the 10-year bond yield, and Rick was mentioning it's 235 today. It's the type of thing where you don't always know where it's right, but I think you know where it's wrong. And 235 seems wrong to me in an environment where I don't think recession risk is actually meaningfully higher than it was before, and where the U.S. economy is sort of trundling along a trend, right? So not spectacular, but also not contractionary. And so you've had this perfect storm of low growth, recession fears, weak inflation momentum, an easy Fed, all of those piling on to low bond yields, which I'm not sure you'd bet on all those factors persisting. That said, I think you do learn something very important about what markets are telling us here. One is that, to your point, as markets reprice growth concerns and recession risk, it's going to create a lot of volatility for equities, reducing the Sharpe ratio of that asset class and make it a little bit less compelling. And secondly, and I think here's the key, as recession risk priced in, we saw massive rallies in treasuries, both in the fall of last year and over the past couple of weeks. So what is your insurance policy against end-of-cycle concerns? It's actually sitting right in front of you, the treasury market.
Carrie, what's your take about what this all means for U.S. equities? And are you optimistic as well about earnings season? And could that be an important factor?
Well, I think one of the biggest factors we have to consider when we look at the 10-year yield is that the competition to own bonds has significantly been reduced. The market is only selling for 16 times earnings this year, less than 15 times next year, and we've got a bond yield that's not competitive. In November, when we were at 3.2%, you could say that investors could choose between stocks and bonds and feel comfortable getting a 3% yield. Now they can't. So to the extent that the market is thinking about earnings growth slowing, you had the offsetting trend where the competition from fixed income has gone down, which is positive for stocks. You asked me about earnings, and I think that the expectations are very low for this quarter. Everyone thinks that they're going to be down versus last year. The dollar headwind is very strong. So it's conceivable that earnings will be better than expected for the first quarter. We'll have some positive surprises, and that could be that could play well through the next month or so. You know, we've been treading water here. The market had that sharp move up, 19% from the bottom, and now it's having trouble pushing through.